Canada might not be the first place people look for growth stocks, but that is exactly why it is full of hidden gems. While everyone is chasing the next hot tech name in the US, some of the most consistent and overlooked performers are right here at home. In this video, I'm breaking down Canadian stocks that are not just surviving, they're thriving, scaling globally, and building real value for the investors. Some are tech innovators, others are powering infrastructure or retail, but they all share one thing: long-term growth potential you do not want to miss. Let's dive in. First up is Shopify, ticker SHOP. Shopify is more than just a store builder. It powers millions of businesses globally and is expanding fast. It now partners with Amazon, integrates YouTube for direct shopping, and is using AI to improve merchant tools. In Q1, revenue grew 27%, and it posted strong free cash flow. Shopify still reinvests heavily, but its reach and optionality make it one of Canada's most scalable tech platforms. From one of the flashiest names in Canadian tech, we move to one of the quietest and most consistent. Constellation Software, ticker CSU, is a compounding machine. It quietly acquires niche software firms and never sells them. With over 1,000 businesses in its portfolio and decentralized model that encourages autonomy, Constellation generates steady cash flow and has delivered over 30% annual return since going public. It's the definition of boring, in the best way. Now let's shift to tech company with global enterprise clients and much broader footprint. OpenText, ticker OTEX, specializes in enterprise software, cloud solutions, and cybersecurity. It serves governments and large corporations worldwide. A recent acquisition of UK-based Micro Focus doubled its customer base. Unlike most growth stocks, OpenText is profitable, pays a dividend, and still has upside in its cloud and AI segments. And finally, in this tech-heavy group, we wrap up with a company using AI to modernize the chain supply. Kinaxis, ticker KXS, provides planning software to clients like Ford, Unilever, and Procter & Gamble. Their system helps companies predict demand, manage inventory, and adjust to disruptions. The beauty of Kinaxis is that it earns recurring revenue and serves industries that cannot afford delays. As supply chains digitize, Kinaxis has carved out a highly defensible niche. Now that we have covered the digital side of Canadian growth, let's shift gears to physical infrastructure and capital-heavy industries. Canadian Pacific Kansas City, ticker CP, recently made headlines by completing a major merger. It is now the only railway directly connecting Canada, the US, and Mexico. That puts it at the heart of North American trade. CP is known for its operating efficiency, and although 2025 guidance was trimmed slightly, the long-term picture remains strong, especially as nearshoring and manufacturing trends pick up. Speaking of long-term growth, our next pick does not build tracks. It moves capital across continents. Brookfield Asset Management, ticker BAM, manages over $1 trillion in real assets like real estate, infrastructure, and renewables. It earns steady fees from large institutional clients, and because of its capital-light model, it can scale without excessive debt. Brookfield is deploying billions into data centers and clean energy, and fee-related earnings are growing at over 25% per year. This is a true global growth platform. Now let's look at a company that is literally helping design the future, one project at a time. WSP Global, ticker WSP, is a global leader in engineering, transportation, and environmental consulting. They are involved in bridges, tunnels, and net zero buildings. And they recently acquired Ricardo in the UK to strengthen their climate-focused capabilities. WSP's backlog is over $13 billion, and with governments pouring money into green infrastructure, the runway ahead is long. Next, let's turn to clean energy, and a company that is growing well beyond Canada. Northland Power, ticker NPI, builds and operates wind, solar, and battery storage projects in Europe, Asia, and Latin America. Its offshore wind farms generate stable income under long-term contracts. While some renewable stocks have stumbled, Northland remains focused, well-diversified, and positioned for global energy transition tailwinds. And to round out this infrastructure section, we have a company that is not as well known, but incredibly consistent. Boyd Group Services, ticker BYD, operates auto body and collision repair shops under the Gaber brand across North America. Think about it, accidents still happen, and insurance companies still pay for repairs. Boyd grows by acquiring smaller shops, has strong pricing power, and delivers steady margins. It is not flashy, but it is quietly dependable. From steady repairs to high-traffic retail, our next batch of companies deliver growth in everyday life. Dollarama, ticker DOL, is Canada's go-to for affordable goods. With over 1,500 stores and growing exposure in Latin America through Dollar City, it has become a retail powerhouse. It benefits when inflation rises and customers look for value. Dollarama also maintains high margins and strong logistics, which help it scale profitably even in tight conditions. Let's now shift from saving money to managing your health. WELL Health Technologies, ticker WELL, operates clinics, telehealth services, and medical software systems. It has made over 30 acquisitions and continues to grow revenue at over 30% annually. Well is building a modern healthcare network with digital tools, recurring software revenue, and a patient-first approach. In a country where access to care matters, Well is leading the charge. From healthcare, let's move into financial access, and a company serving a very specific niche. Go Easy, ticker GSY, provides consumer loans and leasing options for non-prime borrowers. They serve people who might not qualify with the big banks, but still need financing for furniture, appliances, and emergencies. Go Easy has grown earnings for over 20 years, pays a rising dividend, and maintains strong risk controls. It is a great example of responsible lending at scale. And now let's jump into retail fashion, and a brand that has become a breakout star across North America. Aritzia, ticker ATZ, delivers what it calls everyday luxury, and its strategy is working. Its growth in the US has been strong, with new stores in key markets and growing online presence. Aritzia's mix of brand loyalty, influencer marketing, and careful margin expansion make it a unique Canadian retail success story. And finally, let's wrap up with a company that plays a critical role in air travel, defense, and simulation technology. CAE Incorporate, ticker CAE, develops flight training simulators and offers pilot training to commercial airlines and military forces. With a global pilot shortage and rebounding air traffic, CAE is benefiting from high demand. It is also growing its defense and healthcare simulation segments. CAE's business model is capital efficient, global, and driven by recurring training contracts. As you can see, Canadian growth is not limited to oils and banks. From AI-driven software to railroads, from health tech to high fashion, these 15 stocks show how diverse and exciting Canadian markets can be. If you found this video helpful, please give it a like and subscribe for more Canadian investing ideas. If you're also looking for passive income, check out my video on 14 best Canadian dividend stocks to buy in 2025. I will link it on the screen and in the pinned comment below. Thanks for watching, and I'll see you in the next one.